They actually put it in writing. While everyone was glued to the latest political drama, while headlines chased celebrity scandals and Capitol Hill theater, while the financial press argued over whether the Federal Reserve will pause or pivot, something far more consequential moved forward at a summit in Kazan, Russia, something that matters to anyone earning, saving, or investing in US dollars. Not a rumor, not a tweet, a formal set of statements and commitments, published language, official talking points, and policy direction aimed at building a parallel financial plumbing that reduces reliance on the US dollar. Here's what most people are missing. The story isn't the dollar collapses tomorrow. That's not how reserve currency transitions work. The story is that the infrastructure for bypassing the dollar is getting more mature, more coordinated, and more politically supported than many Western analysts expected. The story is that more countries are aligning around the idea of settlement outside dollar rails. The story is that the timeline, whether it's fast or slow, has moved from theory to implementation planning. And once the rails exist, behavior changes. I've spent the last few days reading summit language, comparing it with prior BRICS communiques, studying the mechanics of cross-border settlement, and speaking to people who actually understand reserve systems and payment networks. The takeaway is uncomfortable. Even without a single magic switch being flipped, the direction is clear: more trade, more financing, and more reserves are being positioned to function with less dollar exposure. This isn't about conspiracy. This is about incentives. The question isn't whether you can stop it, you can't. The question is whether you understand what's being built and whether your savings strategy assumes a world that's quietly changing underneath you. Welcome to Finance Reality. Today I'm going to walk you through what was signaled and agreed in principle, how a proposed unit concept is being discussed as an accounting bridge, what the settlement infrastructure is designed to do, what a realistic implementation pathway looks like, and what you can do practically to protect your purchasing power. Because the transition doesn't start with a collapse, it starts with plumbing. The spotlight moment took place around the expanded BRICS gathering in Kazan. What began as a relatively small bloc, Brazil, Russia, India, China, and South Africa, has widened into a larger ecosystem of members, invitees, and partners. The exact count depends on the category you use, which is why headlines can be confusing. But the macro point is undeniable. This is no longer a niche club. It's a broad coalition representing a large share of global population, commodities, manufacturing capacity, and regional influence. Now here's the core idea being advanced: a multilateral payment and settlement approach that reduces friction for trade between participating countries so that transactions can be priced and settled with less dependence on the dollar as the intermediary, not just a messaging alternative to SWIFT, not just bilateral side deals. A deliberate attempt to build repeatable, scalable settlement pathways that work even when Washington disapproves. And that's the key phrase: settlement outside U.S. control. For decades, the dollar system has been more than a currency. It's a network: banks, correspondent accounts, clearing, sanctions enforcement, reserve assets, debt markets, and commodity pricing conventions. If you touch those rails, you are visible. You are exposed. You can be pressured. The proposed unit concept, depending on how it's implemented, functions less like a new banknote and more like an accounting bridge, a settlement reference, a way to net flows without routing everything through the dollar. Some versions of this concept include discussion of a basket potentially involving commodities and participating currencies with heavier emphasis on hard asset credibility such as gold. And whether or not any final formula matches the online hype, the intention is consistent: create a settlement reference that is harder to sanction, harder to freeze, and harder to politically weaponize. Now let's talk about what makes this moment different from years of de-dollarization talk. For a long time, countries have tried workarounds. Russia and China expanded bilateral trade in local currencies. Iran leaned on barter and indirect routes. Others used currency swaps. Those are patches. They're case-by-case, politically fragile, operationally messy. What's being pushed now is closer to system design: institutions, protocols, liquidity arrangements, development financing, technical working groups, settlement mechanisms, legal and administrative coordination, a repeatable framework that can be expanded as more countries participate. that matters, because reserve currency status isn't lost in a dramatic ceremony. It erodes when alternatives become usable at scale. And here's what should get your attention. The countries involved aren't small actors hoping for permission. Many are major commodity exporters, industrial powerhouses, large consumer markets, and politically independent regional players. Energy, metals, manufacturing, shipping routes, strategic minerals. If a meaningful percentage of that trade can clear without touching dollars, the dollar's automatic demand advantage starts to weaken. Now, let me give you the context, the why, because without the why, none of this makes sense. Three forces are pushing this forward. First, the weaponization of financial rails. When the West froze Russian reserves and cut off financial access after the invasion of Ukraine, the geopolitical message was loud. But the monetary message was louder. Reserves held inside Western-controlled systems can become inaccessible. Again, regardless of what you think morally or politically, the incentive effect is obvious. Every government with even a small chance of future conflict with U.S. policy sees dollar dependence as a strategic vulnerability. They don't need to hate the United States to hedge against that risk. They just need to be rational. Second, deepening skepticism about U.S. fiscal trajectory. The U.S. debt load, persistent deficits, and rising interest costs are not abstract issues. They shape confidence. When foreign reserve managers look at long-term purchasing power, they see a currency that must do a difficult job: finance a massive state, service huge debt, and manage domestic political promises while also acting as the world's settlement lubricant. That's a hard balance to sustain indefinitely. And when inflation spikes, even temporarily, it burns trust. Reserve managers don't need a doomsday forecast. They just need a better risk-adjusted alternative. Third, the maturation of non-dollar infrastructure. China has spent years building payment and settlement capacity that can operate in parallel cross-border settlement options, bank networks, trade finance mechanisms, and currency swap lines. Other countries have built regional rails too. The point isn't that one system replaces another overnight. The point is that no alternative exists is no longer true in the way it was decades ago. Now let's address the part that most people underestimate: energy. The petrodollar system wasn't just tradition, it was structure. When oil is priced in dollars, global demand for dollars is naturally reinforced. When oil exporters recycle dollar proceeds into dollar assets, U.S. deficits become easier to finance. So when major energy exporters signal openness to more flexible pricing and settlement, whether that's local currencies, baskets, or alternative settlement references, the implications are enormous, even if the shift is gradual. You don't need a headline that says petrodollar is dead. You just need a slow, steady reduction in exclusivity. Because once you don't need dollars to buy strategic commodities, baseline structural demand weakens. Now let's run the mechanism, not hype, mechanism. Global reserves sit in the multi-trillion range, and the dollar remains the largest share, but that share has trended down over the past decades. A slow decline doesn't feel dramatic until a coordinated alternative makes reallocation operationally easy. Reserves are one piece. Trade invoicing and settlement is bigger. If a block representing trillions in annual trade shifts even a modest fraction of internal settlement away from dollars, that reduces transactional demand. It also reduces the need to hold large working dollar balances. Over time, those marginal changes compound. Less transactional demand can translate into less recycling into treasuries, and that's where the pressure builds. The United States must constantly refinance large volumes of maturing debt. That's normal for a large sovereign issuer, but the buyer base matters. If foreign official demand softens, yields often need to rise to attract sufficient demand. Higher yields raise debt service costs. Higher debt service widens deficits. Wider deficits create political pressure for easier money or financial repression. That's not guaranteed, but it's a known pathway. This is how currency confidence erodes, not in one day, but through feedback loops. Now let's talk timeline, because this is where people get manipulated by extremes. No serious monetary transition is 72 hours, but serious transitions begin with planning, pilots, standards, and institutionalization. A realistic implementation path looks like this. Early phase. standards, protocols, pilot corridors between select trading pairs, banking participation rules, settlement netting experiments, commodity pricing trials, small-scale issuance experiments. Middle phase, broader bilateral settlement capabilities, more commodities offered with non-dollar settlement options, increased use of accounting units for reconciliation and netting, expansion of membership participation. Later phase, deeper capital markets in the alternative unit, more investable instruments, wider adoption by corporates, integration into domestic payment ecosystems, and meaningful reserve diversification. Even if execution is messy, even if timelines slip, even if politics complicate everything, the fact that the rails are being built changes the strategic landscape. Now let's talk about escalation dynamics, because anyone pretending the United States will ignore this is not being serious. Expect pressure, expect warnings, expect sanctions threats, expect incentives, expect diplomacy. But there's a catch. If you sanction every participant, you push more participants to hedge harder. If you restrict access, you motivate parallel systems. If you overuse coercion, you accelerate the very behavior you're trying to deter. That's why this is delicate, and it's why, domestically, you don't hear this discussed clearly. Because admitting vulnerability is politically toxic. It forces hard conversations, deficits, industrial capacity, energy policy, long-term productivity, and the trade-offs of global power. So instead, the public conversation stays shallow. Now let me answer the question forming in your mind. Why are most people not talking about this? Part of it is complexity. Monetary architecture doesn't go viral. Part of it is incentives. The existing system benefits powerful institutions. Confidence is the asset. Acknowledging structural risk can move markets, and markets don't like honesty when it's uncomfortable. But you don't need to believe in a cartoon villain boardroom to understand the outcome. Systems protect themselves. Narratives lag reality. Sophisticated players hedge quietly. The public notices later. So what do? Not panic, not denial, preparation. Reduce concentration risk in dollars over time. If your entire net worth is effectively a long position in the purchasing power of the US dollar cash savings, long duration bonds, fixed payouts, you are exposed to the exact kind of slow erosion that reserve shifts can worsen. Diversification is not anti-American. It's risk management. Increase exposure to assets with pricing power. In inflationary or currency weakening environments, the winners tend to be assets tied to real things and cash flows that adjust. Productive businesses, quality real estate, commodities exposure, and sectors with pricing power. Be careful with long-duration fixed income exposure. Bonds can be useful, but long-duration bonds can become painful if yields rise and inflation persists. Understand what you own and why you own it. Consider a disciplined allocation to precious metals, without fantasy. Gold and silver have served as monetary hedges for a long time. They are not magic. They are not a get-rich scheme. They are a hedge against policy failure and currency debasement. If the world is explicitly discussing hard asset credibility and settlement references, it's rational to consider some exposure. Own what you understand. Manage custody risk. Don't confuse paper proxies with physical certainty. And don't let a hedge become a religion. Think internationally. Not everyone needs offshore vaults and foreign property, but everyone should understand jurisdictional concentration risk. Regulations change during crises. Capital controls exist historically. Tax rules evolve. The point is not to do something extreme, it's to avoid the single point of failure mindset. Focus on income resilience. In transitional periods, the most underrated hedge is the ability to produce value. Skills that stay in demand. Businesses with adaptable pricing. Multiple income streams. If purchasing power gets squeezed, resilience matters more than predictions. And finally, hair signal, not panic. If you care about your family and friends, give them the framework. Don't hand them a scary headline. Walk them through incentives, settlement mechanics, and why diversification is rational even if the dollar remains dominant for years. Because that's the truth. The dollar can remain dominant while still weakening at the margin. The goal is not fear. The goal is preparation with clear eyes. The big takeaway is simple. When nations build alternative settlement infrastructure, dollar dependence becomes a choice instead of a default. When it becomes a choice, the dollar must compete. And when it must compete, the cost of U.S. fiscal and monetary mismanagement becomes harder to hide. If this helped you understand what's actually happening beneath the headlines, like the video. Subscribe if you want ongoing coverage of de-dollarization, BRICS payment systems, reserve currency trends, inflation hedging, and wealth protection strategies. Hit the notification bell so you don't miss critical updates.